It's the time of the year when we look back at our mistakes, but also look forward to opportunities. Joining me in studio is someone who does that too, but for the markets. Paul Hickey is the co-founder of Bespoke Investment Group. Paul, welcome to Bloomberg's Bottom Line. Good to have you on.
Thanks for having me, Mark.
Let's start with the economic data that came out today. We found out the economy growing less than forecast in the third quarter. Is that a surprise?
Well, I mean, it's not really a surprise given the pace of the economic reports and the pace of this recovery that we've had since the recession ended. It's been a slow, albeit steady recovery.
Would this then be indicative of why the Fed is taking the action it has this year, pumping more money into the economy?
I think that's part of the reason why. If you look back at the Fed's actions this year, it's funny. In April, we were talking about the Fed exiting its liquidity programs, and then suddenly that's when the markets and the economy were peaking.
Exactly.
Then we hit a slow spot, and then in August, they came out and said they were going to add QE2. And then right from there, the economy started to pick up. Whether or not the economy picked up because of the Fed or just in spite of the Fed is another question. But we look to the Fed as the authority on what's going to happen, but really nobody knows for sure. And it's just one of these. It's a slow and frustrating recovery that we're going through.
All right, let's take a look at some of what Bespoke was looking at the beginning of the year. You had an S&P target of 1250. That's about a 12% rise. And going into 2011, you're thinking that the S&P might rise only about 7%. That would bring us to about 1340. Why?
Right. Well, looking forward, we've gotten back to where we were at pre-Lehman levels. Coming into
which in and of itself is a victory.
Yeah, exactly. Yeah. So now that's a memory now. But we're still, like we said, we're not in a very explosive recovery here, but we're back to where we were in 2008. And at that point, the economy was going downhill. Now the economy's going uphill. So looking at that, we still think there's room for improvement in the markets. We just don't think it's going to be as robust as what we've seen the last 2 years.
Why not?
We've come far. We've come far, and we've had an 80% gain off the lows here. So we've had a big move. The economy right now is, when we look at the economic indicators, they're still showing growth, but the momentum of the indicators, what we look at, we track the momentum of the growth in the indicators as well as the indicators themselves. And when we look at the last month, we saw a slowdown in the momentum of the indicators. So it's not necessarily a bad signal. It's just not saying that the economy is not really surprising as much.
But the engine of this recovery is going to have to come through job creation and job growth. That's how this economy is going to be explosive, the word you used.
Right.
When are we going to see that? And I sound like a broken record because I've been saying this just about every day, but the unemployment rate is still near 10%. The economy is still spinning its wheels in the mud, but to continue with the analogy, a lot of people see at least the car is starting to lurch forward a little bit. When do we see explosive growth?
That's a question that to know when that's going to happen. I mean, nobody knows the exact answer to that. But when we do focus on jobs are important. But the S&P 500 and American companies have huge international operations, and so investors can also serve themselves well focusing on companies that have some exposure not just to the U.S. consumer, but globally. And sectors that have that kind of exposure are technology, energy, materials, industrials, and all those have broad exposure that will benefit from any U.S. recovery, and they'll also benefit from strong growth elsewhere.
Let's look a couple of weeks ahead to January. What are we expecting the first couple of weeks of the year?
Well, January, when you look at the month of January, it's typically thought of as a very positive month. But if you looking back over the long term, January has very positive returns. But as we look back over shorter and shorter windows, say 25 and 10 years, the returns during January aren't nearly as robust as they were.
Yeah, and talk to me what we're seeing on the screen there, a graphic there.
So this is now looking back at January. That being said, that the seasonal tendencies for January aren't as strong. When we've had periods when we had a strong close to the year, the month of December, where we've been up over 5%, January has been consistently positive with positive returns over 77% of the time. And if in Q4, if the market is up 10% during the fourth quarter, strong fourth quarter, we usually have a strong start to the year with an average gain of about 2.8%, positive returns 83% of the time. Now, one thing is there's a lot of talk about how investors are really bullish heading into 2011, and how with everybody being bullish that the market cannot, that it's going to go down. But you just have to take a step back and think about the historical record of the market. Two-thirds of the time the market is up. So just looking for an up year isn't something to be, isn't out of the question.
Sure.
I mean, that's the usual, that's the norm. So what we want to do is look for reasons. If you think the market's going to go down, you should look for reasons why it's going to go down, and you should have good reasons for why it's going to go down.
Have you heard any good reasons?
There's always this wall of worry that the housing's still a mess, that, like you were saying before, employment's not picking up. But in any recovery, we've been going through the last year and a half of strong market gains, and at every step of the way, we've had investors telling us that this is it, no more. We're not going any higher than this, and the market keeps defying.
Over the last couple of months, with the recent economic data that we've had, has that just about squashed any talk of a double-dip recession? We've been hearing that off and on throughout this calendar year.
Yeah, I think so. I think the odds of a double-dip recession are, nil at this point, and I don't think investors should really be worrying that much about a double-dip here.
Talk to me about oil. We're looking at the price of oil. It's hitting near 90. Oil versus the S&P. What's that look like? All
right. Well, if you look at the correlation between the two, oil and the S&P 500 have never been more correlated than they have over the past couple of years. And if you look back at prior periods where what impact that has had on the market or oil going forward, there's not any clear-cut tendencies for the market. So it's one of those things where most asset classes are highly correlated right now because you have zero interest rates, so money's free, and so people are going into just any hard asset.
Paul, if you had to buy exchange-traded funds in our last minute, where would you look?
Right, like the sectors I was talking about before. I think if your strictly focus is on sectors and you don't want to get into individual stocks, you want to look at technology, industrials, materials, and energy. But at the same time, in every sector, even the best sectors have their big losers, and even the worst sectors have big winners. Financials have lagged the market this year, but you have had areas of strength in the market. Smaller tier brokerage firms have done well. So it's just a matter of, if you're strictly forced to focus on sectors only, those would be the ones we'd focus on. But there's very opportunities in every sector.
In our last 30 seconds, what's next year looking like, overall economy?
Overall economy, I think we're just going to be in this steady pace of a recovery, and like I said before,
slow and steady.
Slow and steady, and if anything, we're going to surprise to the upside rather than the downside.
All right, Paul Hickey, co-founder of Bespoke Investment Group, joining us on set.